this is important. Dollar strength is actually manna from heaven for central banks and sovereigns and institutionals able to capitalize on swapping their dollars at a higher price to lock in NSFR compliant foreign exchange gold at a discount. And that's exactly what we are witnessing. And forgive the pun, this will ultimately trump the Trump trade, which is ultimately extremely bullish for gold. UBS is buying gold at current levels, also verifying that central banks are selling treasuries to buy safe haven gold. This is more an attestament to what we've been talking about for quite some time.
As of late October, gold's performance over the past year, with a year-to-date increase of around 35%, has rivaled traditional assets like stocks and bonds while providing valuable portfolio diversification. Since 2020, central banks worldwide have been purchasing gold at record levels. This affinity for gold isn't new. For decades, many global currencies have operated under the gold standard, where each currency unit backs a fixed amount of gold. The recent surge in central bank gold buying reflects a renewed focus on the stability and security of physical gold amidst economic uncertainty. Andrew Maguire observed that central banks have recently been selling U.S. Treasuries to purchase gold, a move reminiscent of the momentum-driven lows seen in May. He points out the fragile state of the paper market structure, noting that CTAs, commodity trading advisors, are significantly involved in COMEX-related ETFs. With recent dollar strength causing CTAs to capitulate, this has created a self-reinforcing cycle that the Plunge Protection Team, PPT, could potentially exploit. Maguire suggests that these developments underline vulnerabilities in the market, particularly as central banks shift their focus from treasuries to gold. The U.S. abandoned the gold standard in 1933, prompting other nations to follow suit. In recent years, central banks around the world have ramped up their gold acquisitions, buying a record 1,082 metric tons in 2022, with the trend carrying into 2023 with 1,037 metric tons. In 2024, the buying momentum has stayed robust. Central banks purchased nearly 300 metric tons in Q1 and an additional 183 metric tons in Q2, both setting new records for those quarters. By Q3, another 186 metric tons were acquired, indicating sustained demand, though slightly below Q3 2023 levels. As of July 2024, global gold purchases reached a nearly 14-year high. According to the World Gold Council, demand for physical gold assets has more than doubled year over year, highlighting gold's increasing allure amidst ongoing global economic uncertainty. Maguire sees dollar strength as an opportunity for central banks, sovereigns, and institutional investors who can swap their dollars at a higher price to secure foreign exchange gold at a discount. This is precisely what he says is happening now, which he believes is ultimately bullish for gold. We're about to explore the video, but first, make sure to subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
The central banks selling treasuries over the last few sessions to buy gold. And as we've evidenced into a similar momentum-driven May lows, it took 4 sessions for the momentum 96% leverage supply to be overcome by the commercials forced to take the long side of them to meet these T+1 delivery obligations, driving that $150 short squeeze that we looked at. Now we have CPI and PPI driven volatility, where we just had CPI, and of course, look at the usual gained volatility, and we've got PPI, and we're recording this on Wednesday. We've got PPI on tomorrow, on Thursday. We're going to experience more momentums, a little bit of bid pulling, keep the momentums on the short side. That is fully expected. Now, they are short covering into them. Now we've got, as I say, so this likely may cause the final capitulative short covering drive, but at the latest, probably by next week. But either way, CTAs are completely rinsed out. So any more momentum driven selling will be used by insiders to hedge upcoming very large physical delivery exposure, which has not yet overcome this momentum supply. Now, looking at the ever more fragile paper market structure, given the CTAs also populate the COMEX-related exchange traded funds, and have already capitulated fully into the dollar index strength, very short term, it largely results in a self-feeding doom loop, which the PPT obviously opportunistically seeks to take advantage of. However, on the other side of the coin, this is important. Dollar strength is actually manna from heaven for central banks and sovereigns and institutionals able to capitalize on swapping their dollars at a higher price to lock in NSFR compliant foreign exchange gold at a discount. And that's exactly what we are witnessing. And forgive the pun, this will ultimately trump the Trump trade, which is ultimately extremely bullish for gold. Now, momentum traders, as we've said before, they hate sideways action. They either want to be racing long or they either want to be racing short. So given the current risk-on sentiment, we would expect momentum to continue to take the bid-pulled bait. But the as yet undelivered T+1 overhang of central bank purchases, much as it did in May, and we demonstrated that, indicates the bottoming process has been triggered, with the scope of any further selling limited to spec naked short sellers, with commercials building longs against them. Now, as the paper to physical crosses begin to settle down, having already ignited the easily rinsable CTA ETF sell action, the consolidative action in both gold and silver is constructively bullish. Now, while the momentum sellers controlling some 75% of all of the open interest, all the casino chips basically, they will not have any visibility into why the commercials are being forced to take the long side of these useful fools suckered into morphing from naked long to naked short into this synthetic action. Classic wash and rinse cycle. Now, central banks, sovereigns, and institutional buyers have been loading up on the COMEX-driven discounts, ultimately forcing commercials to short cover into the momentum sellers to hedge, as I say, upcoming, still undelivered, very, very large T+1 delivery obligations. And I keep drawing attention to the May the 1st similarities.
Gold has been under consistent selling pressure since the end of October, as investors take profits following a prolonged rally. Last week alone, gold prices have fallen nearly 5%, marking the steepest weekly decline in almost 3 years. From its peak, the metal has now lost over $250 or approximately 9%, making this the most sustained downturn since the start of the month. Although the dollar is gaining strength relative to other currencies, Maguire warns that this impact is limited to fiat gold, not physical gold. He explains that the current market dynamics are being shaped by synthetic pressures, which are causing temporary distortions. These distortions, according to Maguire, do not accurately represent the true strength of physical demand. Now let's redirect our attention to a video.
The knee-jerk market reaction, what it does is correctly read the protectionist so-called Trump trade as inflationary, and that's spiking bond yields higher into a rate-cutting Fed, of course, which is obviously an issue. Consequently, it's these risks that have driven a safe haven race into the dollar. Hence, the automated algorithm-driven inverse reaction in COMEX-centric 4% backed fiat gold and silver. So the action we're seeing is in fiat-backed gold and silver. But it's important to distinguish that into the fiat gold and silver capitulations, which have also ignited naked short momentum bets to sell, other than what could be alchemized at the fixes, not a single ounce of physical gold has been put on offer into this sell-off. And quite the opposite. The selling is purely synthetic. So yes, Shane, the large volume CTA selling has been driven by a race into the dollar, which in the foreign exchange crosses, gold and silver trade as a currency cross. So that's similar, no different to really the dollar against the euro, the pound, the yen, etc. So buying one side of the cross means you're selling the other side of the cross. But under the immediate chart chatter, the current consolidation pullback exposes a significant weakening of the dollar against first-tier gold. Now, obviously, on a short-term 10-minute chart, it doesn't appear to be visible. In fact, what we'll discern shortly is central bank, sovereign, and institutional physical buying have significantly stepped up their buying into this dip, actively alchemizing this synthetically derived bearing in mind that's a 96% leverage gold and silver driven discount into physical. And there's no way of escaping these physical delivery demands that spill out of the casino's back door into the Basel III compliant global delivery markets. Now, the underlying T+1 flow, and we've talked about T+1, it simply means that when a COMEX position lands in London, it is then becomes Basel III compliant, and they have one day to deliver. So this T+1 flow has yet to be fully funded, like ideal. That it means from a 96% leverage position to a fully funded position. And then of course, they have to physically source this bullion at the market price, and then it has to be delivered. Now, the rising dollar, as weighted against the dollar index basket, which comprises of 5 other competing but equally debasing fiat currencies. So, and obviously they are the euro, the Japanese yen, the British pound, Canadian dollar, Swedish krona, and of course the Swiss franc. And it's the dollar rising inside this fiat basket, which actually benchmarks fiat gold. It's important to distinguish fiat gold is not physical gold. And the resulting action has consequently driven the automated, algo-driven, fiat-centric, strong dollar and tail wagging the dog bearish gold action. So really, that's what we're evidencing now.
Looking ahead, experts suggest that the future path of gold will be shaped by upcoming economic indicators and Federal Reserve policy decisions. Traders and investors are encouraged to keep a close watch on global developments as uncertainty lingers over the precious metals market. In the long run, gold's historical resilience as a store of value through countless economic cycles continues to appeal to investors searching for stability amid volatility. In a scenario of continued economic uncertainty, how do you see gold performing against other safe haven assets? Share your feedback in the comments below. If you found this video useful, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.